What happens when emerging fund managers chase their own capital? GP powerhouse Carmen and veteran LP Evan expose how it kills returns and wastes everybody's time.
There's no reason to talk to AP6, the big pension fund in Sweden. If you're on Fund 2, you can waste a lot of time.
The European VC landscape is distorted by fund managers pursuing institutional money they're not ready for.
A lot of funds that are only alive because they got a check from a governmental institution. That takes away capital from funds that maybe have a better chance of delivering the types of returns you'd like.
And it gets worse. Even sophisticated investors fall into the markups trap.
If it's so good, why hasn't Sequoia just marked it up?
But Carmen has a wake-up call about what actually matters in venture.
The problem that some people have gotten into their head that VC is about markups and not DPI. By definition, the more rounds you do it, the higher price you do, you're going to end up with more dilution.
The cost goes beyond just returns. It breaks the alignment that keeps funds healthy.
If you go from 25 to 30 to 100 to 250, I don't think you should be surprised when some LPs say, hey, this is not exactly what we signed up for.
Join us for a raw, unfiltered conversation with Carmen and Evan on how LP-GP alignment makes or breaks fund performance.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome back, everyone, to the European VC podcast. Today, we're joined by Carmen and Evan for yet another episode. We've done one before. We called it the Evan and Carmen Talk Real conversation. And this one is going to be the second part of that. Last time, we spoke about managing the personal relationships versus the business relationships between LPs and GPs. And today, we dive right into the topic of how LPs build conviction. I thought about whether I should pull up a framework for this, but let me just try and describe it and maybe some of the thoughts that I have. So we've published it before on EUVC as part of our fundraising report for the European ecosystem. But what I basically did to define this framework was I spoke to a bunch of LPs, probably 7 or so fund-of-fund investors, and asked them, what do you look for in Fund 1 and Fund 2 and Fund 3? And then I ended up with a framework that said, basically, in Fund 1, it's all about the investment thesis, the coherence with that and the market fit, assessment, of course, of the team, evaluation of the proprietary deal flow sources, the proof of concept for the track record, and so on. And then a bunch of testing of the pure financial metrics and the thinking around the portfolio and so on. Then for Fund 2, we switch much more into a framework of whether the GP has actually done what they said in Fund 1 and whether they continue doing that in Fund 2. Of course, then a bunch of different benchmarks for how people have received them in the ecosystem, the deals they've been able to do, the networks they have been able to get into, so to say, and then if there's a continued alignment of interest and whether they're ready to now step up to the second fund with an enhanced reporting and communication setup. And then in Fund 3 is where the funds really grow up and we get into what you might call what most people expect LPs to look a lot at, and that's of course track record and performance continuity, and of course then the professionalization of the firm, whether the firm has truly managed to grow up and is ready to become an institutional grade fund. And this, of course, also reflects very well how the LP profile changes from Fund 1 to 2 and 3, because you cater basically to a different audience as well, oftentimes, because as you grow as a fund, also grow in fund size. And for that reason, you're looking at different things as well. Evan, I want to ask you first, when I gave you this framework, what was your initial reaction?
I think it touches on a lot of things that, are part of our process. I think every LP is going to do things a little bit differently, but broad strokes, I think you hit on a lot of the important pieces. I think what's important first, if you're an emerging manager looking at this framework, is to first understand if the LP you're speaking with actually invests in emerging managers, right? Because this framework is all predicated on the idea that you actually want to invest in a Fund 1 or Fund 2. But it's sort of like when you speak to a manager and they say, we do like pre-seed or seed rounds, or okay, what kind? And they're like, well, like companies with like at least $3 million in revenue. And you're like, oh, you mean like a Series A round? And so I think you need to, as a fund manager, before you sort of like optimize for all these pieces, you need to make sure that you're actually speaking with LPs that are interested in investing in these, in a fund one or in a fund two. So I think that's just as a piece of advice for GPs, right? I think before you worry about what like your framework is going to look like and how you're going to demonstrate these things in your deck or your data room or your voiceovers, you need to first make sure that you are speaking to an LP base that is actually interested in potentially investing in fund ones or fund twos. And I think it's okay to ask that very early on.
Just a note on that, Evan. I hosted a GP LP breakfast 2 days ago, and I deliberately did that exercise in the beginning of first every LP, because we were 15 LPs and 30 managers or so. And first and foremost, after the LPs had introduced themselves and kind of said what they're looking for, I then had the GPs, raise their hand if they're on fund one and on fund two and so on, because that is just, there's no reason to talk to AP6, the big pension fund in Sweden, if you're on fund two, or at least there's no reason to assume that they would be super excited to, you can waste a lot of time trying to get in the door with someone who doesn't, you're just not a fit yet. And she said that very well as well. As a good example, we invested in Atomico at fund 4.
Yeah, I think that's right. I think as a GP, you need to be really focused in fundraising, because even in the best case, it takes a long time and it's hard. And so you need to be speaking to high quality LPs that look like they could be a fit for your fund, not high quality LPs so you can say you had a meeting with X, Y, and Z, right? So I think being super targeted. As far as the actual framework, right? So
maybe on this fundraising part, Carmen, because you're a killer fundraiser, maybe you're the perfect person to bring in here to just
You're
make sure.
Always so kind to me.
Yeah, well,
I know you look for
killers. I know you look for killers with a heart, so I hope you know that I mean it in every kind way when I say you're a killer fundraiser.
Oh yeah, don't worry, I never take offense in being called killer. That is totally fine with me.
Carmen, on this note of knowing your LPs, knowing who you're talking to, anything you want to put in?
Yes, 100%. And it's a very important one. And I, as always, I'm very happy to share my experience if this is for help to anybody. When we raised Cocoa One, it was October, November 2021. So it was literally like the peak of the market, and people were like throwing money at us. Like it was a completely different market, right? Now that obviously made it easy and looked great back then, but the reality is that we built the LP base in a very reactive way. And we were very lucky that it was a good supportive LP base that was very easy to sort of like low maintenance and very easy to manage, and that made our life very manageable as we built Fund One. But the reality is that then when like it came time for Cocoa Two, the market conditions had changed, and a lot of those LPs that sometimes were fund of funds and were like raising themselves, like had to raise themselves, or some entrepreneurs who used to have lots of cash because their companies were valued at multiple times what their value now, and so like we had to sort of go back to a drawing board and build a more mindful long-term LP base. And think a lot about this at this point of like, what is the right fit? Because as like we know with VCs, like there's not always a fit between Cocoa that is a generalist like at pre-seed first institutional round versus like a Series B fund focusing on fintech only. And I think that is absolutely key on allocation of time. So I would encourage every manager to divide like by categories. So there's fund of funds, there's family offices, there's high net worth individuals, like that's one division. And you need to know what size you're raising and what's your strategy and what fits with you. That's one. The other one is geographically as well, right? Like I have personally been doing a lot of work for Cocoa 2 on US LPs, which had done 0 in Cocoa 1. But with a very mindful strategy, it makes no sense to go to talk to like a U.S. pension fund in like Texas to come invest in like a seed fund, micro fund in Europe. So, but also be mindful of like your strategy geographically, because it also different LPs from different countries think differently. The culture is also different. So the point on the story that you made on Fund One, for example, flies much more in the US than in Europe. In Europe, they want to see who marked up your companies, and like by what multiple. And by the way, the story of like how much ARR does this company have, we don't really care. It's just like about, so like again, just be also mindful of the game that the LP is playing. It's very different a family offices that manages their own money, right, and looks at like high returns in a long-term approach, than a fund of fund that needs to go back and raise themselves. And so like the both like type plus geography, I think is very, very important to have a strategic approach and be very self-aware. Like I'm from Spain, right? I have been introduced to like lots of family offices in Spain that have never invested in venture. Like Cocoa is never going to be the first check of a family office that comes from an industrial land that has never done venture. So I actually was very open with them. I don't think it's like, I mean, happy to chat and go coffee and get to know you, like, but it's not going to be a fit. And so like, that's very important for you to be kind of ruthlessly self-aware with what you want and what realistically fits your model.
Just because you said that LPs in Europe, they don't care about the ARR of the underlying portfolio.
So
Like super important to say, and you touch on a great point, because the majority or many LPs in Europe are not very sophisticated. And you're absolutely right. That is where, like, because it's the first signal that you're dealing with an unsophisticated LP. If they're like super obsessed with your markups and who mark them up and so on, and pay no attention at all to the dynamics in the underlying portfolio.
But we're trying to make that better here, right? That's part of
Yes,
what we're trying to do, right?
so
Is improve the situation.
Exactly. And I think I've discussed this with Evan a lot. I'm going to give like for managers a red flag, actually. Like you need to understand, it's not even like whether they're bad LPs or good LPs. You need to understand the game they're playing themselves, right? And I think that this, by the way, it's one of the biggest problems in venture. I'm not going to talk about Europe, but it might be that this also happens somewhere else. But because there's a dislocation between the fact that we invest in the long term, we invest in long-term value creation. If you want multi-billion-dollar companies, it's going to take years to actually see that happening. But we have to raise every 2 to 3 years. Right. So that jump from fund 1 to fund 2 is actually probably the hardest, because by fund 3, you're running sort of out of excuses of why in 6 years, like you can argue that you have a great company at 1x. Okay, maybe that is a bit harder to point, but from fund 1 to fund 2, it's going to happen a lot. And then you're faced with this situation in which, and I'll again use Cocoa has multiple companies at 1 million ARR. And this is like, the case has changed. But when I discussed this with Evan a few months ago, I had a fund of funds who's actually officially very sophisticated, but asking me to run them through the best Cocoa companies. And I chose 2 Cocoa companies that were at 1x. One was at 3 million ARR, and the other one was at 1.5 million ARR. But they were at 1x. And in fact, in one of them, we had given them more money to skip the seed, as we call it. We keep that like skip the seed. Okay. And the fund of funds argument was, wait, but like, if they're so good, like he asked me, why did you choose companies that have no markups? Cocoa has 14 companies that have that follow-on. So I could plenty choose of markups. Like, and like he said, like, why are you choosing one? But surprised, not like blown away positively, just genuinely surprised, right? And I was like, because they're the best companies right now in terms of team execution, business execution, and visibility on market size to think of outsized returns. And the answer was like, well, if it's so good, why hasn't Sequoia just come mark it up, right? And it's so hard to explain that actually, by the way, as a manager myself, because Cocoa is so small, I make no money on fees. I make money on returns. If I can actually help a company skip the seed and save 20% dilution, I'll do it every day of my life, right? But I understand, by the way, this is not a critic on the fund of funds, because I understand that they cannot do the work on 38 companies. So their signaling is who does the next round and at what price.
It speaks to the problem that some people have gotten into their head, that VC is about markups and not DPI. And by definition, the more rounds you do it, the higher price you do, you're going to end up with more dilution, which means that if you were the first investor in, you'd be happier if you hadn't had that seed round at a 4x markup.
And it's a problem, right? Because the reality in this company where I am telling you they skip the seed is that they skipped a 5 at 25 million seed that they had a term sheet, and they raised this Christmas 10 at 50. But I understand, by the way, that as a fund of funds, like you want to see the markup because you also need to raise money. So it's not that they're like bad, or it's just that the model in there it's broken between the short-term fundraise on our side and their side and the long-term that we need to create outsized value.
Yeah, and maybe a comment on your categorization in the beginning, just because you mentioned fund of funds as fund of funds was a big basis of the LP base in Cocoa, and you raised. I thought you had 4 actually. Sorry.
No, we had 2 like proper fund of funds. We had some big checks, but they were not from fund of funds.
Okay. But just I wanted to come in with the point that longevity is oftentimes what you connect with having a institutional investor, which means you have a fund of fund. But unfortunately, the fund of funds in Europe are not always super long term in that they're all out fundraising themselves. And I honestly think that we can definitely count on one hand the funds that are able to give you a good signal that they're going to be able to be there for the next fund if just you perform well.
And they try, by the way. As in, like, again, it's not a personal critic on them, but like,
No.
I am going to say this, and I might get slaughtered for it, but I think that Europe has not enough LP depth especially for like emerging managers and like smaller funds. Of course, if you're very established, if you're like by Fund 4 and you're Atomic, you have access to all these pension funds. But when you are raising sub 100 million, probably, Europe doesn't have much depth of LP base, and it's a problem. It's a problem for emerging managers to raise. It's a problem also for where the value created is gonna stay. Like there's a whole rolling thing, and I know lots of people are working on it, and I'm like also trying to work on it, but it's a problem.
I literally came just before this podcast into a conversation with a professor who runs a program at one of the premier business schools in Europe, only focused on getting LPs more sophisticated around venture. And he feels like he's banging his head against the wall to to figure out how to do this because he hasn't really been able to be as successful as he would like. I also say, I said to him, man, this is our raison d'etre with EUVC almost. Like that is why I founded EUVC in the beginning. I want to increase the transparency of European venture. I want to make clear who are the champions of European ventures so that the families that want to invest can very easily dig them out. When they're approached by a VC from their own ecosystem, they can very quickly benchmark them up against what something else in Europe looks like. Because a European fund just looks different from a US fund. So benchmarking up against Sequoia on Harry's podcast, well, that's kind of like, yeah, he's not Rolf Botha, but probably still a pretty okay investor. So
Evan, how do you see that? Because actually there's so much talk lately, obviously, about Europe, US, and the whole thing. But when you look at the LP base, because you've done so much work in Europe, you've met so many like funds, but also so many LPs in Europe. Everybody like trusts you and shares their experience with European LPs. And like you also have the US experience, right? You're based there, you like sort of grew up in venture there. Like, how do you compare those ecosystems?
Yeah, so it's interesting, right? Because I think the US has 2 sort of advantages, right? One is just the venture market is more developed in the US than it is in Europe, right? And therefore you have a more developed LP set. But then also just numerically, right? The number of investors, right? Sophisticated, unsophisticated, family offices, fund of funds, high net worths, angels. So there's sort of like, there's a developmental advantage and there's like a numerical advantage. To me though, right? If you are a fund, you don't need a million LPs, right? You just need the right LPs. I think the problem in Europe right now is I don't know if you have sort of the right LPs, quote unquote, to sort of like back enough of the types of managers that are needed in the ecosystem, right? And so what winds up happening is I think there's a lot of flailing around, right? There's a lot of, okay, well, if we can't get the right LPs, we just need as many LPs as we need to sort of fill up the bucket. But I don't know if that necessarily helps improve the ecosystem. And then on top of that, I think we talked about this last time, and this is a soapbox that I will always happily get on. For all the good that some of the local institutions do, the EIFs, the KFWs, the BBBs, right? And they really are doing a lot. In some ways, they create a situation in which capital sort of chases like, oh, well, if EIF is an anchor, then it must be safe. If BBB is an anchor, it must be safe. I'm not saying that they make good, bad, or otherwise like on their investment decisions, but their objectives are probably different than your average fund of fund, or their objectives or their time horizon are different than your average family office or ultra high net worth investor. And so I think you have a lot of funds that are only alive because they got a check from a governmental institution, which then allows them to get a bunch of sort of people who want to chase those institutions as LPs, and that takes away capital from funds that maybe have a better chance of delivering the types of returns you'd like from a venture fund. And I think it also stunts the development of the ecosystem, because if I'm a GP or I'm, GP, I'm like all the GPs in aggregate, I don't necessarily need to work as hard to develop the ecosystem or like put my stamp on it, because if I'm a good GP, I know that EIF or BVB or KFW will write me an anchor check, and so then I just need to slot in a couple of other LPs, and all of a sudden I've raised my fund. I think in a world in which that money is not available, it's not as easy, GPs collectively need to make more progress in helping the LP ecosystem develop. And I don't put it all on GPs, right? But I do think in the US, there's a well-developed ecosystem of LPs. They've seen multiple fund cycles. They've gotten capital back. They know what it's like to invest in a good fund and a bad fund. That doesn't mean every LP is a good one, but it does mean you have enough that you could sort of support an ecosystem. Worth noting, obviously, that in the US, you have a lot of clustering, right? There's been a lot of stuff written over the last 12 months about 50% or 60% of the capital raised in USVC going to 8 or 10 or 12 funds. So I'm not saying everything in the US is perfect, but you do have enough LPs just numerically, and I think you have enough capital and enough sort of sophistication that you could have a healthier like LP GP dynamic. Whereas I think in Europe, you just don't have that. I think some of that is because there are a lot of LPs that are maybe just not interested in investing in venture. They don't get it. But I think some of it is the market distortion that's brought on by having large governmental institutions write anchor checks, and then people just chase the funds that got those checks.
Evan, I don't think, at least I haven't heard.
Sorry if EIF is one of your sponsors.
No. I have a big critique of the EIF that I'd love to bring on the table. I don't have that one specifically, because at least it's not something I've heard too much. I know 100% that EIF does act as a really nice, not rubber stamp, but it definitely acts as a great entity to make sure that nothing is wrong with the fund.
Sure. They're great. They're operational due diligence.
I hope that at least that we don't have too many LPs that like chase the EIF, because that would not make a lot of sense. Like, because you don't just want to follow the EIF. But I do get 100% that you as a family would say, we don't have the internal capacity to do the deep DD on making sure that everything is right. So for that reason, we do need a very big LP to be in, be that a professional fund of fund or someone like the EIF. And I think that that's where they play a big role. I think that we definitely have ecosystems in Europe where the government institutions do play such a big role that if you don't have money from them and they're bagging, it is considered non-kosher, or there must be something wrong. I don't think that's a problem across Europe. I think that actually many of our very best funds say no thank you to EIF money.
I actually wanted to say that, and I'm going to shout out here to Bogdan from Underline, which is the biggest fund in Romania. I don't know if it's Eastern Europe, but for sure in Romania that has no public money, and it's $20 million prox. I don't know the exact size. And big shout out to that. But because what you're saying is right on the DD side of things and outsourcing. But I also think that as a manager, so for example, Cocoa doesn't take public money, and it doesn't take public money because I don't want the restrictions that come with public money. I understand the value of that, but as a manager, and in the UK, I can do that, right? And with a generalist thesis and the access Cocoa has, I can do that. But go all those who are like taking that approach in Romania, where it is like orders of magnitude harder, because that the kind of waterfall event of this is also, what are you investing in, right? And what are the incentives, again, going back on the game that everybody is playing. And I want to make sure that my game is not restricted by any geographic or like thesis approach. So that's my stand personally as a GP on the public money. I can do it because I'm small. I understand that if you need to raise 1 billion in this ecosystem, you can do it probably without EIF, and they play that role. But I think that those who in hard jurisdictions manage to do it without public money, like, big shout out.
Yeah, hats off
Right.
to Bogdan 100%.
I mean, to be clear, right? I think the work that EIF and BBB and KfW, like, I think they're doing super important work. Like, if you look at the Israeli venture ecosystem, it only is what it is today because in the early 90s, the Israeli government set up this program called Yozma, and that like launched the whole ecosystem. So I think what like these institutions are doing is super, super important. I'm not, the criticism here is not of them. I think it's that when I get a deck from a VC in Europe, more often than not, it will say, oh, EIF is anchoring or KfW is anchoring. And Andreas, I don't think they're doing that because they want you to know that EIF already did a very rigorous operational due diligence and they're clear, right? And so I do think you have a set of LPs that are not, to the point before about, oh, did Sequoia mark up your company? I do think there's a set of LPs that say, well, did EIF invest? Did BBW invest? Did KfW invest? And they say, well, if they did, it must be good. Like, check, check, check. It's fine. Again, I'm not criticizing the work that those governmental institutions are doing for whatever flaws they do or don't have. I think it's super important. But I do think there's a class of LP that just use that as a rubber stamp, the same way they view a Sequoia markup as a rubber stamp. And then they don't have to develop that muscle or that internal sophistication to evaluate funds properly.
I do have a critique of, because you said, I'm not saying it to critique them. Let me critique them. I do love the EIF. I do think they're incredibly important. I do think that the ecosystem would not be where we are today in any way
100%.
if we didn't have them, nor would we if we didn't have IFO in Denmark or TESI in in the Baltics. Like, I get that 100%, but I do not understand why they would ever say to a manager, instead of saying we are not investing because, they're saying we are only investing if. Like, that sentence does not make any sense to me. Like, if Carmen comes to me and says, Andreas, I'm raising a fund to do X, Y, and Z, either I'm in because I believe in Carmen and what she's doing, or I'm out. I don't say to Carmen, well, I would like you to have a male co-GP, or more often the case, a female co-GP, or I would like you, the two of you, focused on this, and then I want, because this is important to me, this sector, I want one GP fully focused on this.
Exactly.
That makes zero sense.
100%.
Like,
it's not obvious to me though that large institutions outside of government money are not. I mean, maybe like it's a little bit different, but I don't know that it's like qualitatively different in the sense that I've heard stories of large U.S. fund of funds or large global fund of funds that go to, for instance, emerging managers and say, we'd love to write you a check. We know you're raising a $30 million fund focused on X. If you would double that to like $75 million and do this, then we could write you a $25 million check and we could be an anchor. So that is different, like quantitatively. I don't know that it's a qualitatively different thing when you're changing somebody's fund strategy.
This is great. This is spot on. And I've had that with follow on. So Cocoa is very outspoken. We don't follow on. And this is out of scope here, but happy to discuss at any point. But this goes back to my point that as a GP, you need to be very aware of the incentives of the LPs that you take money from, right? And again, these people want to, like, this fund that tells you that you should follow on or like you should raise 75 million, and is because they have their own game to play. And in this case, probably is they need to deploy, and it doesn't make sense for them to deploy less, doesn't move the needle and whatever. And so you just need to don't waste your time with funds that are not a fit for your strategy, and do the work to understand what is actually the why of those LPs investing and whether there's a fit. And if there's not a fit, no problem. You don't need to fit everybody, right? Like, you stick to the strategy that you believe on, stick to your own superpowers, and there will be eventually people who match that. One thing that I have seen to be different so the more sophisticated you go with LPs, the more they understand that it's a commitment for the long term, right? Like, I have met LPs who literally just commit to one fund, and that means that unless you end up in prison or run away with the money or something, they are committing for quite a few funds because they understand that this is a very long-term game, and it takes long-term to show actual results for real value. And two, that also because of the risks that we take, it might be that you have one extraordinary fund and the next fund is horrible or takes longer or is low. And I'm sure you've all seen all the newcomer, like he's publishing all the returns from UTIMCO, like, and you can see, right, like, that sometimes if you want to like do a 10x of a fund, it might be that the next fund is like, 1x or 2x. Like, how do you think about that commitment of like, do you invest in one fund or do you invest in multiple funds?
And then, so I think this actually dovetails nicely with the matrix, Andreas, that you were talking about, because how you sort of evaluate those funds in sequence. But I think, Carmen, to answer your question, right, I think the way that we think about it when we invest in a manager is we expect that to be a long-term multi-fund relationship, provided that, nothing material changes, right? And so I think the goal here is to say, venture is a long-term game, it's a long-term asset class. Results sometimes happen very slowly and then all at once. And so I think there needs to be a little bit of patience, right? And there needs to be an understanding that if you like the manager, that should be thought of when you invest in the first check as the first of sort of a set of checks. However, I think that is only true if you have a strategy that's oriented around finding managers with strategies that should work across multiple market cycles and that are resilient to changes in sort of like the overall market, right? So if you're trying to sort of dance through the raindrops and pick one vintage from this manager and one from this and one from this, what is the likelihood that you're picking correctly? I would sort of put forward that it's probably not that high. I think you need to find people that have strategies and that have unique access and that have a unique sort of right to win or unique sort of like GP thesis fit. And then you need to really get conviction that that's a strategy that should work across multiple market cycles. And so I think when we invest in a manager, our expectation is it's going to be sort of a multi-fund commitment. That doesn't mean we're putting anything in writing, right? There's nothing guaranteed, right? Because things do change. But in general, our expectation when we invest in a manager is that that should be a multi-fund relationship. I think the flip side of that, though, is that if you as a GP materially change your fund over time, you should not be surprised when LPs that invested in earlier funds take a step back and say, hey, is this really the same product, right? So if you go from 25 to 30 million, I think you should expect that most LPs will know that's sort of a normal like inflation-based change, and it's not a big deal. If you go from 25 to 30 to 100 to 250, I don't think you should be surprised when some LPs say, hey, this is not exactly what we signed up for, right? Meaning I don't think LPs are making a commitment that they'll follow you, through fire and brimstones, right? I think that as long as, everybody knows what the journey entails and that stays the same, then you should have a reasonable expectation that your LPs are going to be, interested in multiple funds. But if you change something materially, it shouldn't be a surprise, if some LPs decide that's not the right product for them. And then one more very small point, and then I'll let you make your point, which is I think as a GP, I feel that you have to have the same loyalty to your LPs that you expect from them. So if you accept friends and family who decide to roll with you in fund one when you're raising your $10 million micro fund, my personal belief is that if they want to write you a $10,000 check when you're on fund three and you're raising $50 million, you have made the agreement with them implicitly that you are going to take their checks until they are no longer interested because they supported you when you were in the very beginning and there was nothing to rely on. So I think there's also that agreement, right, that GPs should implicitly have with LPs, which is if you back me in fund one, no matter what, like even at like whatever the case is, like I will take your check and I'll figure out a way to make it work.
Can I ask you, just because we've had this conversation many times with the GPs, because we do feeder structures, right? And almost everyone on fund two or fund three, they get to a point where they have this group that they want to continue accommodating, but they're also getting to a point where it probably makes sense to roll them into a feeder.
That's fine. Yeah.
The two of you have any perspectives? You're saying that's fine, Evan. Have you had any thoughts around that, Carmen?
It's a very interesting question. So the point with me and Cocoa is we're built on angel list. So that means that administratively, like it doesn't really like having 10K checks. My only point is I do the capital call up front for anything that's below the minimum check size, and then they don't take any additional work. So from an administratively perspective, it doesn't really make any sense. It's actually more complex to probably have like a feeder structure than like what that takes. My only restriction is I cannot have more than 99 LPs because of the SEC, and I am so luckily like far away from that. That would be like intense, but I don't, because I have it sort of solved. But I think that you need to manage that loyalty, which is like absolutely core to me. The gratitude that you feel when somebody trusts you before you've actually sort of made them any money, and that trusts you with that commitment, I think you should never forget. Like, there are certain cases, like I do feel overwhelmed with gratitude in like people actually believing and wanting to log in, be institutional, be their personal money into Cocoa for 14 years, trusting that I'm gonna like return it. And that's something that you should never forget. At the same time, you run a business, right? And so like, it's how do you combine those? I'm very lucky that on Angel List, that is pretty easy to manage.
We see, just a note on it, what we see is everything from they will roll people into a feeder and they will put the cost of that feeder on the LPs. Others take it themselves and say, we took their money in the beginning, now we need to do this, so we'll put them, and we've seen anything in between that spectrum. So I think really everything is fair to do so, to say. It's just a matter of how to do it. I think there's a lot that say that they view this group also as typically strategically relevant. And for that reason, they put the cost of the feeder on the rest of the LPs, because actually the big pension funds should be super happy that this group is still there and supporting with all the operational stuff. So for that reason, there's an argument to be made there.
I think one thing that Evan said, and he used the word a few times, is probably very important for emerging managers, and is this notion that you are selling a product. And just like the word product, like just understand that. Like, you're selling a product to LPs, you're selling a product to founders, and you're selling a product to the market. And you knowing what that product is very important. And so, and that also explains like whether, that also makes it easier to understand like whether that product like fits with other strategies of LPs. It also makes it more easy to understand that if you completely change the product, like, well, the buyer of the product might reconsider buying it again. But it's very, very important that you understand that. And also, that's a more rational, like, kind of strategy level, but also at an emotional level, by the way, especially if you're like a solo GP. I sort of was able to verbalize it this summer, which is Cocoa sells a product and I am the product, right? And just knowing that, like, and understanding that that also has its trade-offs, and like that you are like what the fund is selling, and your superpowers, your investment decisions, your network, your relationships, that's what the fund is selling, is very, very important to manage everything that comes around building that product. So I think the word product is a key one to incorporate in your understanding of what you're actually building.
So maybe just to, I guess, loop this back to how we evaluate this product, for everybody who's been waiting 39 minutes to get my answer. So I think it's, I think the framework you put together, Andreas, is it's pretty solid, I think, in terms of the points it touches on, right? I think it hits sort of the keynotes. I guess a couple of things that I would sort of overlay on that. So, first piece is when we're sort of evaluating this product, right? Because I think that's sort of what it is, right? You're bringing a product to the market. We have to decide, do we buy this? Do we not buy this? For us, like fund one, but even continuing right into fund two or fund three is, are you a credible investor? Do we believe in you as the investor and the GP running this, or the team of GPs that are actually running this? And then, does the thesis make sense? Do we like it? Do we believe the thesis? Do we believe this is a thesis that is going to be resilient again to market cycles, right? And work over the long term. But then it's also that interaction term, right? It's, are you the right GP or GPs to be executing on this thesis, right? Because a lot of times we will see people who identify that there's a certain zeitgeist, and that's great, but they're not actually the right people to be executing on that, right? And so you need to actually have that, like, it's analogous, right, to founder market fit, right? You need to have like GP thesis alignment or GP thesis fit. And so I think that's super important. One other thing which, I know you have sort of like a little bit later on in the matrix, right? But something we look at for fund one, which I don't think a lot of LPs do, and I'm frankly not sure why, is historical track record from the GPs, right? So I want to see your angel investments. I want to see the stuff you did at prior funds. I want to see like all that stuff, because while, past performance is not indicative of future results, those are helpful data points, right? And I think you could start to see patterns. You could start to see directionally things are helpful. Like if you think in fund 3 that the fund 1 performance is going to be really important in making your fund 3 decision, then why in fund 1 or fund 2 or fund 3 are investments that are even more seasoned than the fund 1 investments not relevant for your investment decision making process?
Yeah, so we have it in the fund 1, but we call it a bit deliberately a different word than track record and performance continuity. Instead, we call it proof of concept through track records or analogous achievements. And that's because a bit of this recognition that when you're coming to market with a fund 1, it's not always, viewed as just the pure track record. Sometimes you need to be a little more creative in putting that together. And I do think that you're absolutely right that, of course, it needs to be looked at. I also try and not put it in as the first line, because probably also a bit of a pedagogical aim here to say, fund 1, this is not where you spend all your time.
When you look at track record, do you look at the output, and it's probably a combo, but like, do you look at sort of the output, or do you look at the decision that was made with the information that was available at the time? And answer, and then I'll tell you why I sort of battle with that. Ideally, at one point, those converge. Like a good decision leads to a good output. But as you're assessing it in the midst of development, like how do you think about that?
So I think input and process are always super important, right? Like how did you source this investment? Why did you think this was a good decision? How does it compare to other decisions you made or other opportunities that were there, right? Like all the sort of input questions you'd assume, right? How'd you diligence it? How'd you underwrite it, right? Like I want to know that you have a really solid process that you've sort of refined a little bit. And that should, over time, lead to better outcomes, right? But the outcome is still relatively uncertain generally, right? Like if you just left the previous fund where you were for 3 years, now you're launching your own fund, those investments are only 3 years old, right? And so I don't expect there to necessarily be outcome yet. And so I don't want to over-index on that, but I think process is super important. But the other thing that's actually very, very helpful is figuring out, of your track record, how many of these investments or, what percentage of the investments, broadly speaking, sort of map to the thesis you're trying to execute on now, right? Like, did you work the muscle before and now you just realize that this is maybe a better product or a better vehicle to like continue to do that? Or are you being opportunistic? And I'm not even saying that as a value judgment, right? But I just want to understand, like, have you done this? What is your ability to source deals at this stage or in this sector, this vertical, in this geography, right? And I think looking at prior track record is helpful because it gives you a sense of what ponds was that person fishing in before, and then how relevant is that for what they're trying to do now. So I think it's really about process and about understanding how relevant their past experience is to what they're doing now, and less about, what's the markup on that company, because again, I don't think that is necessarily something you're going to have a lot of clarity on at that point.
I think it's funny, Carmen, that you ask, because I spoke earlier today with a GP that has gone from crypto to European resilience. And I, of course, asked him a bit provocatively, so you flipped from crypto to to defense. Tell me about that. And then we had a super meaningful conversation about, well, what was the thesis behind them doing crypto to begin with? And how did crypto then play out? And how does the skill set and the things that they saw for crypto then kind of develop? And where are we today? And why does it then feed actually quite well into European resilience strategy? Because obviously European resilience, I was also making it provocatively because the subsector of European resilience is quite closely tied to cryptography and cybersecurity and computation and so on. So for that reason, it makes a ton of sense, right? But from the outside, you can definitely frame it as the other. And for that reason, the nuances are here super important, because we're all watching the market and we're all hearing the critiques of the funds that flip or the teams that flip from crypto to resilience, because that's the zeitgeist.
I haven't heard the European resilience expression. It's like
it's as soon as you get into, because people don't like to say defense, so now or or weapons and so on. They
Okay.
pivot
Yeah.
to
Okay.
resilience.
Interesting. The reason I asked, and I've discussed this actually, this framework with Evan, but so being very clear that we're here to make returns, like that like, let's not forget that is the ultimate goal. It's also interesting to me, or it helps me to acknowledge that there's so much randomness, right? That we don't control, and I'm talking as a pre-seed investor, on that output. And so how I try to like kind of hold myself accountable, and this is why I'm interested in how an LP thinks about it, is that my formula, and I say Cocoa's formula, is best access, rigorous decisions with the information that you have available, and then obviously hard work, right? And I call it like it's network, muscle, and hustle. And I also say like it's EQ, IQ, and EQ, JQ, so judgment, AQ, and IQ. But there's this concept that if you have the best access and you consistently make good decisions with the information that you have available at the time, which is obviously not all the information that will determine the outcome, with rigorous processes and work really, really hard, you will end up hitting the right thing. And it's also how I try to learn from things, in the sense that whereas a company ends up being like a mega success or not, like the decision, was it the correct one with the information that was available? Because that's what I could sort of control and can learn from. Because I might make a really bad decision, like Anchors, and then the company ends up being the bomb. Like, does that, like, what do I learn from it? And so I always think of this idea of like network, muscle, and hustle, or like best access, good decisions, and hard work, right? And it's interesting to see how LPs think about it. When you fundraise every 2 to 3 years versus your day to day, and how you keep saying basically on your day to day when you invest in basically the unknown.
I was just going to say, this is something we spend a lot of time on, like, if we're looking at a fund 2 or a fund 3, right, is what were your lessons learned, and how did you learn them, right? Like if you made decisions with the best possible decisions with the information you had, great, right? The outcome won't always be what you want, but like, the goal is to sort of shift the curve right in the direction you'd like, or increase the probability. But to the extent you made decisions that were, suboptimal, even at the time, what did you learn from them, right? And like, how do you incorporate those learnings going forward? I think that's super important, right? Because you, of course, want to make the right decisions with the information you have all the time. But the reality is, in venture, that just doesn't always happen, right? It's so, what were lessons learned? Are you making the same process mistakes over and over again? Or, have you learned from them and refined what you're doing? I think that's super important, to make sure that the manager has like that self-awareness to improve their processes over time, and to really identify like when they made a process error, let's say, right, and how they can avoid that in the future, improve that in the future.
Carmen, you did Hopin, and Carmen is smiling, Evan is smiling, and Andreas was thinking, can I bring this up? But I do think it's an incredible company and investment to pull up as an example of thinking through, because I'm sure you've spoken to so many about it, because back a couple of years ago, everyone looked at it and said, but this is the best investment ever. And then COVID ended, and everything that we thought about how the world would change after COVID also changed. So I'd be super curious to hear kind of, how do you think about Hopin?
Spot on. So this framework that I just described also derives from thinking a lot about Hopin, and thinking a lot about my decisions in Hopin, and also how the market sees like that, right? So here's the ruthless, like fully honest, no filter view. It's like, I invested in Hopin. So I put together 100% of Hopin's pre-seed. Summer 2019, COVID was an award. Introduced him to the lead at the seed, October, November 2019, COVID was an award. I could have sat the whole
Did
summer.
you know Fauci? Did you know Fauci? Did you know something inside?
So that's exactly what I was going to say. It's like, I could have sat the whole summer trying to size the market, and I would have never thought about COVID, right? So now, while Hopin was getting increasing, and like Axel joining, and Norson, and IVP, and General Catalyst, and A16Z, and Altimer, and basically the who's who of like venture, packed in and got it to 7 billion plus. My pre-seed decision was the best, decision in the whole wide world. And then obviously, to your point, COVID ended. There were many things that went there, that went down, and Hopin ended up being not a good outcome. Now, does that change the pre-seed decision? because the information I made that decision with was what I did, right? And I also actually, and I think a lot about this is, and I'm very open about it, Hopin's pre-seed was a great investment decision because it was an exceptional founder who proved to, like, regardless of what has come down, to take a company from 0 to 7.75 billion in valuation and not get just sucked by that tsunami. That company was 6 months old. So yes, COVID was a wave, but you had to ride the wave, right? And you had to build product and sell product and raise money to do that. So there's no question at pre-seed, it was an exceptional investment. Now, it was a really bad Series C, Series D investment. Yeah. And so what I say is, what did I get right? I got right that there was this founder was exceptional, right? And what did I got wrong? That I didn't sell at Series C, at Series D, right? And so this is the key idea, because if I only look at the output and make Hopin a bad pre-seed investment, I also don't learn. Because it was a good pre-seed investment, it was a bad Series C investment. And so I think that is how I actually sort of thought a lot about this framework that I explained theoretically. Hopin is the best example of that.
How do you judge, when you make a bad decision, even in the moment, right, or with the information you have, it's sometimes easier to be like, well, I just didn't do this research correctly, or I missed this data point, or I fell in love with the founder, or whatever. How do you adopt that same self-criticism when it's inaction, right? You didn't sell. Okay. What do I point to that caused me to not sell, or to not exit, or to not do something rather than to do something?
I didn't even think about it, which is the problem of the European mindset, back then my mindset as well, that we were, and I think Europe got very sophisticated in understanding that venture is a business of access and that you need to be in the best companies in order to stand a chance. And therefore, we got very good at competing for investing into companies. But this mindset of DPI is a new thing. We sort of didn't think that this business was about making money. We thought it was about being in the best companies, but not about making money, right? So the reality, and why it was a sort of bad decision, is I didn't even think about it. We obviously were in the middle of collective delusion in 2021, and everything was gonna IPO and stuff. But realistically, I didn't have the mental mindset and framework to actually think about even selling. And so that has been a huge learning, and it has informed a lot of Cocoa's strategy, going forward. But the reality is, it was a bad decision in the sense I didn't think about it.
This was not a Cocoa investment, am I right? It was an angel investment.
Years before Cocoa. It was 2019.
Yeah. So, because I was just about to ask you, this is where I love Team Isomer so much, Joe and Chris, because they've been around, they've seen it all, my feeling, and that's also what I hear from their managers, they do flag, and they did in the 21's flag, guys, it's a good idea to take chips off the table. The LP perspective on this, I do think it's one of those roles where, because especially as a solo GP, you're, again, back to the killer framework. You're a killer, Carmen. You're going out there. You're playing the game in the arena. You're doing it incredibly well. You have so many great properties that I would, and you and Anthony, 100%, I would have backed both of you back then. We were a bit late to the show and all that, but you're incredible, and I could see that, right? And LP should continue backing new managers coming to market that are, come with all their power and might. And we know as LPs, they're also not 45 and have been here for 3 cycles.
Correct.
And that's where I think the LPs should step in with their knowledge in the LPAC and just in the WhatsApp groups and so on, and say, remember to, and so on. Have you seen that, Carmen and Evan? Yeah. Do you do that? Do you see others do that? And Carmen, I'll let you go first, of course.
So Cocoa is an angel investment. Was an angel investment. Sorry, yeah. Cocoa was an angel investment. And so that they imply, but this is something that I tell to LPs, and why, by the way, in Cocoa too, I've spent a lot of work in trying to get the right LPs, is that I know the power of Cocoa. I see it. What I do not know, because I don't have the perspective of time, and I don't have the perspective of having seen many top funds perform across vintages, is what can come back and bite me. And I actually asked this question, first time I met Evan, I think, Evan at Pimlico Fresh, I did ask you, is what can go wrong that I'm not seeing? I think LPs, and this is why you want a good LP base, why they say money is not the same money, right?
I know now why your LPs didn't say anything, because they were afraid you're just going to go right off to Bahamas and never come back. Like, have you thought about selling Hopin at 5 billion? Wait.
You're making actually a point. You're making a point. My husband sometimes laughs about the fact that, we never sold and the whole thing. He's also pissed that I didn't give him an allocation.
At least he could be in Bahamas.
But I actually tell him always this. I was like, I don't think, and this goes back more to human nature, and if I would have made that money, I'm not sure Cocoa would be a reality, and I'm not sure that I would be fighting the same way, and not because I wouldn't have the same passion, but because you make these amounts of money. And by the way, this is another problem with venture and age in venture, and the thing is, and you're not in Luton at 4 a.m. sending emails and speaking to Evan, who's still awake in Philadelphia, and if you have huge amounts of money in your bank account, the hustle, human nature gets comfortable, by definition. And so I'm actually grateful to have this chip in the shoulder, because you bet it drives me.
That's a very positive spin on that situation. We'll check.
I'm an optimist. I have to be. Yeah, Luis looks at me, my husband, I'm not sure I buy into this. But I'm an investor. I need to keep optimistic. No.
We sometimes we tell the stories even to ourselves that we have to hear.
Yeah,
totally.
Yeah, no, it's a good spin. I'm glad that you're able to put a positive spin on it, because I don't know that I would be so positive about this situation.
Cocoa is literally the best thing that has happened, and anything that sort of took me to Cocoa, I'm grateful for, and it's just Hopin is a big part in me having Cocoa, and in Cocoa.
And honestly, Carmen, I think that even if you had sold at the best time and you got super rich, you would have spent 2 months or whatever in the Bahamas, and then you'd be.
I don't like the Bahamas very much, but that's okay.
I think we're all driven enough to not stop just because.
Don't kill my argument. Don't kill my argument.
That's true. Sorry about that. Evan, LP, the LPAC's role, the LP's role in helping managers that haven't been around forever, or just in general, helping managers in the places where they're maybe not the most sophisticated. What's your view? Also, when do you underwrite a manager where you know that they're blind sides?
The LP's role is complicated, right? Because I think some of it is dependent on how sophisticated the LPs actually are. Some of it is dependent on how much they actually want to be involved, right? You could have very sophisticated LPs that run very sophisticated diligence processes, but then they don't necessarily have a team that wants to support those funds post-investment. And then it also depends on the GP, in that some GPs, a lot of GPs, in fairness, sort of view LPACs as the reward you get for writing the largest tickets. Other GPs, I think, view it as an actual source of advice where they can get advice from LPs without having to go to all 50 LPs. I do think it's a little bit idiosyncratic, right? It does depend on your particular LP base, and it depends on, the manager and sort of how that dynamic. But in general, right, I think that GPs, they do, I think, given sort of just industry custom, need to reward sort of their largest couple of investors with LPAC seats. But I think they should then say, okay, now are there, 1, 2, 3 other LPs who maybe didn't write the largest checks and are helpful or sophisticated and can actually be valuable here as a sort of a formal voice on the LPAC. And so I think maybe, there's some improvement to be had there where you do a combination of, your anchor investors and then maybe, your most helpful LPs to the extent that those are different. And so I think there's some work there. But even if you're not on the LPAC, right, I think you have a responsibility, or you should feel you have a responsibility as an LP to be actively engaged with the GP. Now, that doesn't mean that they need to hear your opinion on everything, right? I mean, you need to save your bullets for when it's important. But I do think that when you feel like this is a real existential moment for the fund, or this is something that, the GP has just not had the reps, to actually, have seen before, I think it is prudent and it is worthwhile to step up and say, hey, I just want to point this out. You're the GP. You make the decisions, right? I have no ability to force you to do anything, but I would be remiss if I didn't bring this up to you and say, hey, have you considered this or have you thought about this? And so I think, again, you need to save your bullets. You need to be smart about it. But I think as an LP, you have an obligation, or you should feel like you have an obligation to speak up when there's something that's a serious potential issue for the fund.
It's super welcome. I think being a GP is a pretty lonely place. And if you have people who understand the market, who understand the model, who believe in you, and can actually be that, a trusted confidant who has skin in the game and context and can help you. I mean, that like a good LPAC, whatever format, by the way, like where is like that is gotten, because it is a very lonely place. And to your point early, Andreas, like we're doing many things for the first time. And this is actually a key point. I think that we all have been trained as investors, right? But we haven't been trained as fund managers. And it's a different thing, and it's different skills, different challenges, and so like having LPs that you can go to and you can like confide in, learn from, is like a gift. And actually, I was thinking as we were speaking right now, and all these points around LP assessment and fundraising, I do a lot of work for like trying to lower the bar for emerging managers. And I think that some like companies like AngelList, Carta, like they've done an amazing job in simplifying, bringing down the cost and simplifying the setup of a fund. But you still have all these things like raising a fund and like managing a fund. And so I was thinking, and maybe Evan can share some thoughts. It's like all this discussion that we have, like what does it actually mean, not only for GPs who are in the arena right now, but for any investor that knows they're good investors and they're maybe in somebody else's fund or in big structures and are potentially considering building their own vehicle to like invest themselves. Like what does this all mean to them?
Yeah, I think it's a great point, Carmen. I mean, we spend a lot of time, obviously, with emerging managers and smaller funds. And something you realize is that, the job of being an investor is very different than the job of being a fund manager. One of them is a lot more fun, and it's the one you want to be doing. And the other one can kill your fund and takes up
I can certify that.
Yeah, and takes up a tremendous amount of time, right? It's really it's its own job, and it frankly takes up more time in a lot of cases than the investing job. And so I think to Carmen's point, how do we improve that? How do we make that experience better for people? To improve the ecosystem generally, whether it's in Europe or in the US, how do we find ways for people who want to raise a fund or are thinking about leaving their current fund to be able to go out and focus on investing, which is what most of them want to be doing, not fund management. How do we make that happen? And so, I think to Carmen's point, some of it is people like us being involved in the emerging ecosystem, broadly. But, my door is always open to, people who are thinking about launching or thinking about leaving or think that maybe they'd be a better investor in some other structure. I've had lots of confidential conversations with people and, would love to do that in the future. And I think that's also helpful, right? It's helping people understand what is it actually like from the LP perspective, for you as a GP who wants to go out and raise a fund. What does that look like? What are the hard parts? How can we make that easier? Or what are the ways that, that becomes more viable? But I think it's really, really challenging for a lot of people. And that is one of the things in the European ecosystem that's tough, is that right now it's really hard to raise a fund because the fundraising environment is tough, but it's also really hard to raise a fund because, the fund management piece is something that people who are trained as investors are not necessarily prepared to deal with. And that is a barrier for sure. And so it's something that's also, I think, a broader issue. And there are LPs that are able to be helpful in those situations if you as a GP or a prospective future GP are willing to use those as resources and actually tap them for information.
I am always I find it a bit difficult, this whole democratization of access to venture or making it easier, quote unquote, to become a fund manager, because it's always this, it is a super elite industry. Like the best performing people in venture are super elite. And then we're all talking about democratizing access to it. And I'm like,
Oh, to be clear, I'm not talking about democratizing access in the way that phrase is commonly used. I just think there is the ratio of like managers that Europe could handle as a continent or as a venture environment versus the number that exists, I think is off right now. I don't think that means that everybody who thinks that they are like unhappy being an analyst somewhere should go out and raise a fund, right? To be clear, right? I'm not saying like we should just make it extremely like easy to do that, right? It should still be hard, but the question is it hard because convincing people that your thesis makes sense and that you're the right person to execute on that thesis is hard? Or is it hard because we put up a lot of unnecessary like fund management roadblocks, which are a problem, right? So I think you still need to be able to go out and sell your thesis and sell yourself as a person and sell yourself as an investor. I am not saying we should like eliminate that. But if you have unnecessary barriers that are taking people who otherwise could be improving the European ecosystem and do have good insight and good access, and you're instead precluding them from starting a fund because being a fund manager is just not really fun, like that's a different thing.
I think that's two things. And I actually, Andrea, thinks you're like, we're all saying the same, because probably democratizing is not the right word. It's also, I think it's two things. It's one, understanding. I am ruthless with people who want to start funds and come to me and like and say, oh yeah, 5 million. I'm like, never gonna work. Like, just run the numbers. Like, you can't run a $5 million fund. It just doesn't work. So like in that, for sure. And also, what's your product? Like, some, they have this very brutal phase. Why do you need to exist kind of concept? So but I think there's a difference between that and understanding. And I think one of the biggest challenges of today is we don't know. Like, we just spent like 2 episodes trying to decode how LPs think. And you're talking to like, we've been doing it for almost 4 years. And there's so many things that are mind boggling to me. Like, and so like, I think lowering the barrier in terms of understanding, in terms of knowing, like, how many structures do you need when you set up a fund, and like, how is actually the fee schedule, and like, what are the costs, and like, and then decide with like knowledge, of course. I think that's one. And then also the execution bit is interesting. Thinking about a better ecosystem. I think a lot of people get into the rhythm that VC is an operational business. And you get into that because there's so many ops, because we obviously are managing third-party money, and that comes with like regulatory constraints, because you're managing multiple structures. Like, a fund is not just like, you managing the money. It's like multiple structures, and there's so much complexity with it, and there's so many legal documents, and there's so many management accounts of all these entities. And like, and so we get sucked into these ops that actually are necessary to run the fund and stay out of prison, but that are not what's going to make the best fund, right? And that's not why any of us does it. This is a business of, we're saying, JQ, of judgment as well. But judgment requires space, and you need space to think and process. And so I think that there's that part on execution that also can be solved or helped to raise the bar. And that will raise the bar, because we'll have better investors if people spend more time thinking, right? Then if people like churn through like ops. And so I think there's these two things to consider, is like the understanding, the visibility, which like we have very little of. How does the system actually work? And that's your mission and why you started EUVC. And then there's the actual execution. Look, this is not an operational business, but it requires operations. How do we solve the conundrum?
And that's why Carmen works from the tarmac at Luton at 4 a.m. because nobody else is there, and she has the space to think. With nobody else around her.
I know. Anybody go to Luton? It's the best, like space to think from the terminal.
Best advice ever given on the European VC podcast. So we are now up on more than an hour of recording and the time slot at which we have to end. Guys, I want to spring a question on you before we close. We've now done 2 episodes of this, just riffing almost on the back of a script that no one can follow. And
I feel like we didn't even cover anything. We had like so many things to cover.
I feel like I want to ask you, are you up for doing another one in a month's time? So we kind of keep the cadence.
We are, and we will be better. Yes, we have tons. I have so many questions for Evan on things that like I still want to learn about LPs.
I think we have come to an agreement that we'll do another one.
Wait, but before you hit the gong and end this,
yes.
I do just want to say I got a really good feedback from the first episode, and a lot of people who asked really good questions. So for people who are like interested in what we have to say, if there are specific things you want us to touch on, you know how to reach at least one or probably all of the 3 of us, and we would definitely appreciate questions.
And we'll take them, then we'll bring them to the next one. Let's do that.
Yeah, I think it's super helpful.
We'll eventually get to them. There were some today. Everybody who had questions, we had them here. Some got answers, some will get answered.
Yes. Yeah. That's the deal. I love this. This was like, it maybe sounded like we got very quickly to agreement that we're going to do it, but it was really impromptu, and I just asked. Thank you for joining me today and for committing to joining me another day.
All right, thanks for having us back.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.